Hey everyone, welcome back to the Mark Loeffler Experience. We got another great show here for you today. We're going to talk about how to pay off your mortgage in 5 years. So start to finish, pay off your mortgage. I'm going to go through some basic mortgage stuff. Not going to go into it super heavy, but I want you guys to get the clear picture on how to do this, how to set it up, and how to make this happen. And I don't want to be here for an hour explaining it all to you. If you want me to talk about how mortgages work in Canada or the US or wherever you guys are, just comment down below, let me know, and I can make another video on that. Let's get into it. Oh, if you guys do like the content, I would love it if you could subscribe. We're almost up to 900 subscribers as of today. And definitely comment and smash the like button for the YouTube algorithm. And if you do find this helpful, if you want to share it with friends, more than welcome. All right, let's make this happen. So we're going to start and we're going to say, all right, we have a $500,000 mortgage in Canada on a 25-year amortization, which is pretty normal. And we're going to say at about a 3% interest rate. So we have a $500,000 mortgage. And basically how that works in Canada, if you were to pay off your mortgage every month with your payments being $2,366.23, you would pay that off in 25 years, and your payment in the first month, $1,242.26 would go towards interest, and $1,123.97 would go towards paying the mortgage down. And then obviously in month 2, your interest is calculated on the total loan amount, which would now be $498,876. So your interest would be $1,239.47. And you pay a little bit more every month towards your mortgage. Over the course of the loan, you're almost paying $210,000 towards your mortgage, right? We all understand that. If we just pay our mortgage every month, it goes down a little bit every month. It's calculated on the total principal that we owe that month. So how do we pay it down quicker without making any extra payments, or how do we pay it down quicker without us spending any more money? How do we use the bank's interest to help us pay our mortgage down quicker? So how do we, instead of paying them $210,000, how do we use some of that towards the principal? So, I mean, if you guys have Googled this or YouTubed this, there's tons of people out there talking about it. It's basically talking about velocity money. And it's basically talking about the difference between two types of mortgages. So we have a 25-year mortgage and at a fixed rate, and then we have a HELOC, which is a home equity line of credit. And with the mortgage, it's basically your principal amount is $500,000. We're going to calculate 3% interest, what the payment is for the year. So, I mean, I can do that, the nifty little calculation here. $500,000 times decimal 0.0003, which equates to $15,000, right? And then we divide that by 12, which equals $1,242.26. Right? And then obviously in the next month, we went through that, you're paying less money. But that's the basics of how mortgage works. It's going to be a little off, and I'm going to share this with you is basically because it's calculated semi-annually in advance and all this fun stuff. At the end of the day, this is the basics of how you pay mortgage, and then the next month, they'll calculate it at that 3%, and you will pay interest on that amount. Basically, how we want to do this is when we set up our mortgage, we want to get what's called a home equity line of credit. I mean, I'm sure we've heard equity loans on the radio, that type of thing. Yet really what I want is I want this, I mean, it doesn't have to be, yet it's very simple. If it's tied to the mortgage, it's very easy to do. All right, so I get a HELOC, home equity line of credit. It's tied to my mortgage. So if I have a $500,000 mortgage, my HELOC is basically as I pay down my mortgage. So I paid the principal of, I get $1,100. That goes on to my HELOC, and I can use that for whatever I want. Basically, it's like cash in my hand. So what I'm going to tell you is we're not going to go buy cars with it. We're not going to go buy furniture. We're not going to renovate with this. We're going to use this to pay down our mortgage quicker. Actually, you don't even have to use that portion. I mean, you can at some point, yet you don't need to. So with most Canadian mortgages, you're allowed a payment of, I mean, at least on mine, I can prepay 20% of it per annum upfront. I get my $500,000 mortgage, and in that first year, I can prepay $100,000 of that amount at any time. So what this does is now I have $100,000. So what I want to do is I want to put $100,000 on my home equity line of credit, and now I'm going to have a $400,000 mortgage. So you have a $400,000. Let's talk about how that looks. $400,000 now on your mortgage, right? You have the same payment, but you times that by 0.03, and now that is $12,000 a year. Times by, or divided by 12 is $1,000, right? So now you're paying $1,000 in interest on that mortgage. Now, I know what you're going to say is you're going to say, well, no, I still have the $100,000 in my home equity line of credit. And of course you do. The difference is what I want you to do is I want you to treat the home equity, I want you to change your mindset. Most people have a checking account and a savings account. And we use that to, I mean, basically for our life, right? So we typically put all of our money into our checking account, and that's where all of our monthly bills come from. We pay our credit, we pay everything through that checking account, right? And then we have a savings account that pays us very little. I mean, even if you have a high interest savings account, what are you getting? 1.5%, 2%? Is I want you to have the home equity line of credit, and I want you to treat that like it's your savings account and your checking account. So we want all your money that comes in. So let's just say we want all your money that's coming in to be put into your home equity line of credit. So we want you to treat this like a checking account. Your paycheck, you make dividend money, or you have rent money that comes in. We want this all to go into your home equity line of credit account, and we want to pay all our bills coming out of that. A HELOC, different than a mortgage, the interest is actually calculated daily. We have that $100,000 on our line of credit. So if we carried that for the full month, we pay a little bit extra, so probably like 3.5% for our line of credit right now. So we would be, again, for the year, we'd be $3,500. Divided by 12 would be almost, $290 a month. So now I know you're going to tell me, well, Mark, now I'm paying more. I have $1,000 plus $290. Yet what I want you to do, because this is calculated daily, is if I have $100,000 to start, here's my level. And then I get a paycheck and it goes down, right? And then I get something else and it goes down, and then I pay a bill and it goes up, and it goes up and it goes down. So basically what's going to happen is through the month, it's going to calculate my interest daily. So the first day I have $100,000 in there, right? So I get $100,000 at the 3.5%, $300 for the full month, let's say, because it makes math easier. So it's 30 days. So that day is going to be $10. The next day, I got a paycheck. Let's just say I make take home every 2 weeks $4,000. So now I'm $96,000. Now I'm paying 3.5% on $96,000. So maybe my daily interest is $8 or $9. And then over the course of the month, I'm going to end up paying less money. Or even if it's the same money, that's fine. Basically, what I want this to do is I want this to become the savings account. So this necessitates that you're actually spending less than you make. Now, you can't really pay down your mortgage quicker if you're spending more than you make. You can, yet you're just going to sit here with a home equity line of credit. And at the end of the day, your payment is still going to go off on your thing. So it's going to actually pay that down quicker. You're going to get a little bit more equity. Yet this really works for people who can save more than who can spend less than they make. Everybody should be spending less than they make. If you're not, you have other issues and you have a spending problem. So what this does is now I'm paying that down. So the next month I start with $98,000. And then I've paid down more on the mortgage. I'll show you how that works here. Now I'm paying off almost $1,400 a month. And by the way, it would have taken me 82 months to get down to that level. So now I'm paying off $1,375 a month, and I'm only paying $990 in interest on that loan. And I'm not paying any extra, like I'm probably paying the exact same amount. I'm paying that little bit of extra interest on the line of credit, yet I'm paying that extra, I'm paying more down on my mortgage over time. I mean, I'm obviously just going to rinse and repeat, and then I'm going to do that again in year 2, and I'm going to take it down to $300,000. And then once I've got it down to $300,000, which would be basically year 12 in your regular mortgage. And basically what I'm doing is if I'm getting bonuses or if I get some found money, again, if rents go up, I'm basically putting that money into that HELOC to drive down how much interest I'm paying there. And obviously the more money that you're putting in there, the more you're paying it down and the less interest you're going to pay over time, just because it's paid daily. And I'm hoping again that you're saving every month, and by the end of this, it's going to just revolve quicker. And yes, you're going to have to, again, spend less than you make to make this happen. Yet at the end of the day, you can pay this off super quick, and you can, 5 to 7 years, you can get this done. And guys, this is basically just velocity of money and using instead of lending your money to the bank at 1% and they go and lend that out 10 times at 3%, because we know that's how the banks make all their money, you can basically become the bank, and by putting the money in there, you're saving 3.5% rather than earning 1%. And you're saving that much more interest on your home loan, because as you pay it down, you pay less interest. So the third year, you go ahead and do this again on 24 months, takes you down to $200,000. Again, you're in year 17, you're paying down almost $2,000 a month on your mortgage and $1,900, and you're paying $500 a month in interest. Hopefully this helps, guys. I do this on my own mortgage, and I know that it works. I do the 20% down a year. I actually do a little bit extra if I can. What I do is I pay 10%. Like, you can raise your payment 10% a month. I also do bi-weekly payments, but I'm going to do another video on top 10 tips for paying your mortgage down quicker outside of this. Things that you can do that don't really affect your daily life. All right, thanks everybody. Again, if you like this, if you enjoyed the video, smash the like button, share this with your friends. We'll see you guys in the next one. Have a great day.